Unfiltered opinions.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
And I'm Simon Brown.
Welcome to Insider Exchange.
To the TikTok already. Are we live? Oh, there we go. Good morning. Welcome to Insider Exchange. Welcome to Market Matters, live streamed every Monday morning for your viewing pleasure. This week's Market Matters is proudly brought to you by our friends at Thrive. We thank them for their partnerships and collaborations and for them helping us to continue doing the work that we do. We're joined in studio by Thrive's Trading Services Manager, Sean Dendere, to take a look at market movements and see if we can make sense of what's been happening. We're going to be taking a look at the clawback of tariffs, or not clawback, or walkback, not walkback. We don't know what to call it anymore. We're looking at tariffs. We're also taking a look at gold reaching all-time highs, and we're going to take a look at some important economic data that will be coming out this week, if that even matters. Sean, good morning. Thanks, as always, for joining us in the studio. I see they got the spelling of your name right. They got everybody's names right this week, so that's always a plus. There's no I's.
Did you
There's no
explain
dots
my
on
name,
the
though?
I's. I did not.
Oh, beautiful.
I didn't have to explain the name, and that's what made me extra happy about it, was that it was spelled properly and we didn't have to do it. We're still waiting for our community to give us some name suggestions on what to try out, because I'm sure this doesn't always end this well. But now that we've got a good base case for what we hope is going to be good spelling, we'll see how the rest of it shapes up. But let's get into Market Matters. We try on the show. We genuinely put in an A-class effort to not discuss the orange Mussolini every week. And every week, it doesn't
Okay,
happen.
so I've got somewhere we can start with Artem. Although it's
We'll circle back to him eventually.
Goldman Sachs says gold could plausibly trade above 4,500 by the end of the year.
That's Goldman Sachs' call on the gold price. I would believe it.
Gold miners, if that happens, gold miners, their profits more than double from here.
I want to trust our own reliable gold source. We all know who it is. She's
Yep.
not here. She called $3,200 a fine ounce. Shout out to Mushima. We will have her back on the show because I want to see if she agrees with the $4,500 call.
No, not 4,500, 4,000, right?
4,500.
$4,500. There you go.
So like you said, Mishima said it, right? Believed her. So every time, right, I go onto a show and they ask me, Sean, what's your stock pick? Simple, straightforward. Guys, just go and get a gold ETF and sit. Because the rest of the other stuff, leave it to professionals. Because like you said, clawback, reprieve, are we inside, are we not inside? But gold has technically been consistent. If we go back historically, look, when there's uncertainty, what happens? Gold shoots up. I do believe that is going to go to that 4,000 mark. Going back, because Goldman Sachs said it, right? I think they already called at 3,500 mark by, I think like June or something. So like by the middle of the year, gold is going to reach 3.5. So I guess they are seeing further growth in that price.
Well, I suppose they're all seeing the same thing, and
We're seeing.
we're all seeing the same thing, and we're seeing your new trading strategy around downloading Truth Social. And I want you to tell us about that, because that is informing probably what Goldman Sachs is looking at from a risk perspective.
No, 100%. Look, technicals, fundamentals, that is the traditional way, to trade. I don't want to call it the safest way. By the way, everyone trading is quite risky, but it's got nice upsides to it.
And this is not trading advice from Sean Dendere or the Thrive team?
Thank you. Look, it's simple. In my opinion, just download Truth Social. You don't have to interact with anyone there. Just follow one person, Donald Trump. Make a notification on your phone. And once he tweets, see what he says, or I don't know what they call it on Truth Social, once he publishes or whatever. Cool. Take a position. Because whatever fundamentals that you're looking at that point in time, whatever technicals you're looking at,
matter.
just throw them in the bin. Game over. You said something else.
Folks, that was not financial advice. The show does not provide financial advice. You've seen the disclaimers, and we have the disclaimers in audio as well for you to listen to as well. That was not financial advice. That was Sean's opinion based on the current market activity, which isn't
But
wrong.
I like it.
I mean, if we think back to Trump version 1. I say version 1 because that was his first presidential term in office. Every time he opened his Twitter or his X or whatever you want to call the platform now, the market moved, right?
Exactly.
This time around, and we spoke about this as well, Sai and I spoke about this about 2 weeks ago to say, now the tweets don't really have the thing, right? Because one, Truth Social is a platform there, the news drops there first, but also the main thing around it is executive orders have been the flavor of the year
lovely.
from January 6th, right? So where something isn't explained in or articulated in a Truth Social post, you can best believe there might be an executive order that'll follow around it, right? Hence the tariffs. So again, we're back in that cycle of where do we go from here? And I remember asking Sai this question when he was announced as president-elect last year, when we did our Christmas specials around that time, towards the end of the year. And I said, do we think it is physically possible to have a more volatile second term than the first term? Because you remember how the first term was.
Very volatile.
And I didn't think it was possible. And I don't remember what Sai said. But whatever the outcome of that conversation was, boy, were we wrong.
Yep, it is more volatile. And the thing is that if you're in a constitutional democracy and you Liz Truss and there's a lettuce and you last, 40 days or something, the trick with Trump is that there's only really 3 ways for him to exit: death, resign, or Section 25 of the Constitution. None of those are happening. So we've got another 3 years and
What's Section
9
25 of the
months.
Constitution?
I think it's
If
impeachment,
he's-
is it not?
No, well, impeachment. But
Yeah, he survived 2 impeachments. I wouldn't bank on impeachment. He survived 2 already.
Section 25 is when you're mentally incapable.
Mentally incapable.
Yeah.
But that requires a lot of
It's
proof.
not
and-
it's not section. I think it's an amendment.
How do you? I don't even want to know how you prove that. for a
So
sitting
basically,
president.
what happens is your cabinet. It's 25th Amendment. Basically, it's his vice president and his cabinet.
Okay, so this is why you appoint a vice
addresses
president that's not going to ask
presidential-
questions.
Exactly.
Yeah. So it's a 25th Amendment, addresses presidential succession disability, providing for the vice president to become president if the president is removed from office, dies, or resigns, outlines fulfilling it, etc., etc. But part of it is also for incapacity. Now, the theory is that Reagan was incapacitated for the last 2 or 3 years. The thing is, no political party wants to do it, right? You put the man there, now you got to take him away because orcs. So the short answer is, outside of death, and to be clear, you wish death on no one. Trump is old and obese, but he's there for another 3 years, 9 months, and 7 days.
You make that sound like such a long time.
It is a long time.
Yeah, Sean.
I have a question that I had. I asked Simon this question off camera.
Yeah.
Right, but I'm going to pose this question to you, in your opinion. What's more, since we're speaking about volatility, right? These markets that we're currently experiencing versus COVID markets, in your opinion? Simon gave his answer, but I just want to hear what your thoughts are.
In terms of volatility these times, so COVID was a very simple thing. Nobody knew what was going on. The entire world went into a lockdown. It was a market crash, collapse, down to a level, done. And we kind of found that base and held at that base until we started to come out of that, or until we got good news. It was one direction. This is markets come down, an hour later, markets are up, an hour later, they're back down. So this in
Red
terms
light,
of
green light.
Exactly. Red light, green light, Squid Games all over again. In terms of volatility, this is far more volatile than COVID. The COVID pandemic, much like the 2008 financial crisis, was a sell-off. One direction, done.
Fair.
This is the Wild West. You are on one side of the field. I'm on the other side of the field. Whoever draws their gun first survives. And then when you survive that, you have to go play red light, green light. It's like that level of volatility. And you can start to see it in the fact that different market participants are approaching it differently. Institutional is looking at it one way. Retail traders and investors are looking at markets another way. Long-term asset managers from a retirement perspective are looking at it another way. So think about something like crypto. When crypto was introduced, all of the retail market was saying crypto is going to, go to the moon. Then institutional got involved, and you're like, okay, maybe crypto will be more controlled. Now retirement funds can't get into crypto. So you see how different players play around differently. Now, unfortunately, with the level of volatility that you have, there are certain mandates that go off. So in the asset management and in the fund space, if a certain stock or a certain sector or a certain event happens, they are trigger events, right? So my investment mandate says if I lose more than 10% on something, I must liquidate.
Exactly.
And so you're seeing forced liquidations. Not that we wanted to liquidate, but forced liquidations in line with mandates.
Yeah. And so 2020, the S&P was down 32%. We're only down 12 at this point with the S&P, 12.7. Fun fact, in 08, it was down 55%. Oof. Hit the low in March 09.
See? And then when we hit the pandemic, we came down to that March 09 low, stayed there, didn't bounce off of very erratic.
Well, no, it went up pretty quickly. I mean, the 09 bottom was March, and then it was back at highs by Feb 13. So it took 4 years to get to the highs. The pandemic, we were back at highs in August. So
yeah, when the lockdowns were lifted.
Sort of 5 months. No, August 2020.
August of 2020. Oh, interesting. Yeah.
And then, of course, there was the bear market of 22, which was down 20-odd%. I mean, in terms of direct downness, this is like, there's one in the last 20 years, it's number 3. It's just beating the 2018 sell-off. In fact, no, not quite. So it's only the fifth worst so far in the last 20 years. The difference, as I said to you before we clicked record, is that every other crisis that I've ever seen, and I can go back to 87 on crises, is that
it's a lot of crises.
Everyone in the world is frantically working to try and solve it.
Yes.
This time, not everyone in the world is frantically trying to solve it.
That's because this time not everybody in the world caused it.
Yeah. And that's the difference.
This was a single-handedly, like one-sided driving factor behind the volatility. The global pandemic, we can at least argue that the entire world went into shutdown. Everybody had to protect their own countries. All governments had to make different policies. The 2008 financial crisis, everybody had to liquidate their positions depending on what they were exposed to. This time around, none of the market participants have caused this.
Precisely.
Yeah.
Okay.
Fun fact, China says it's just detected Somalina in American poultry. Don't mess with the Chinese.
Well, speaking of not messing with the Chinese, I want to look at that before we jump into some of the data that's coming out today. The response around the tariff walkback from a market perspective. For a bit of context, when the announcement was made around where we are going, Capitec went down to 2,500 Rand. Sasol went down to 55 Rand a share. These are just local counters, right? We're not talking much bigger companies.
Exactly.
Today, as we sit here, Capitec is back above 3,000 Rand. Sasol is back at 66 Rand a share. So the reversals and the swings are far more erratic and far more volatile. Yes, some of these companies have underlying issues and all of that. But let's be clear, something like a Capitec that moved down to 2,500 was entirely the announcement around South Africa and the tariff imposition on the South African context, nothing to do with Capitec's performance, right, as a share. And you saw that with First Rand as well, coming down all the way to below 60 Rand, back at 70 Rand now. So markets have behaved that way. And interestingly enough, from a Chinese perspective, you'd expect that would have happened. There was that one day where the Hang Seng lost 13%.
Yeah, but it'd been closed on the Friday, remember?
That's it. So they were kind of recovering from all the movement that didn't happen. Now when you look at markets and you look at the walk back or not walk back, you've now got two different sides of the story. The American side of the story, American businesses, American business people, entrepreneurs, those that are big Trump supporters are like, no, a walk back is not a sign of weakness. It shows that Trump is willing to negotiate and he's trying to explain the seriousness of the situation to China, and it is for China to come to the party and all of that. And a walk back is certainly not a sign of weakness. And then you go on social media and you see the memes. The memes don't agree with.
Well, here's who doesn't also agree. So Larry Fink, CEO BlackRock.
Oh, there we
I
go.
think we're very close, if not in a recession now. Jamie Dimon, CEO JP Morgan, recession likely outcome.
Okay, wait. Let's just put that into context for our audience in terms of assets under management at the moment for BlackRock.
Isn't BlackRock biggest in the world?
It is the biggest asset manager, right?
It's
much is
not
it?
biggest by a small margin. It's biggest by a long shot. The Vanguard Group sits at 9.3 trillion in the US.
This is dollars, guys,
This
by
is
the way.
this
This
is
is more than
trillion
SA Inc.
US dollars. BlackRock is 10 trillion US dollars. For context, that is a third of the entire United States' debt. Their debt sits at 34 trillion.
Oh, you kicked that door open.
Well, I mean,
US 10-year.
well, there you go.
When was it? One of the days last week. I forget which day. I wake up, I get up 4:30, and the 10-year is on my watch list, always has been. I never look at it because it's the most boring thing in the
Doesn't
world.
move,
It
really?
moves down to like minute little basis points so far off the screen, you got to zoom out to see it. And the thing was collapsing. I had, which of course collapsing means yield up, price down. I'd never seen something like that happen before. It was like in real time, it was collapsing. And that was when Trump then did the big walk back on Wednesday.
Yeah, I really want to touch on that point, right? And this is going to go back to your point about the markets turning around. I don't think it was a walk back in terms of, oh no, we're coming to the negotiating table, etc., etc. I think it was really economic pressure that pushed him to say, okay, guys, sorry. Let's negotiate, because we're looking at the US bonds, right? They were becoming less attractive. The dollar was becoming less attractive. So technically speaking, I mean,
But that's-
all US indices were crashing, inverted commas, right? So if I carry on this path as Make America Great Again, right, or whatever the slogan is these days, surely I'm actually just smashing the country down. So
Yeah.
someone should have said to him, like, look,
No, but Sean, that was the plan. So remember, if the whole plan behind this, and this is the conversation we had about genius or maniac and whether or not this was all the strategy, if the entire plan from day one was to bring down the values of things and to readjust valuations and to allow for someone like the Federal Reserve to have to cut rates. This was the plan. The plan was to reduce the value of the dollar, was to come into a situation where the global markets weren't at the heights of the valuations that they were, right? So almost like a reset of sorts. And that was the point that we argue to say that if that was Trump's plan all along, there are so many different ways he could have gone about doing that. And this was probably the most extreme way to do it. But if that was the plan all along, then you were on the right trajectory. I think what you're saying around the market reaction was the market didn't anticipate that it would happen that quickly and
That's
that
exactly-
violently,
exactly,
right? And so now you don't know where to from here, because if you crash, I mean, if we come down and we crash to, say, pandemic levels, and we break through pandemic levels and we go back to 2008 levels, which were also seen in the pandemic as well, the moment you go below 2008 financial crisis levels, now it's every economy must recover for themselves. And even if you can pull it out of the hat as a United States, there's no way you're going to pull it out at the rate that China's going to do. So inherently, like, I think kind of gets to the point that you're trying to make, I think, Sean, around the fact that you run the risk of tipping your market out of being the largest market in the world, which China's already projected to exceed America in a couple of years' time as being the world's largest economy. And if that happens and you accelerate that process, you take away all of the power that America used to have as the largest economy.
And the power's gone. So here's a fun fact, staying with 10 years, and I'm rounding up to the nearest 10th. United States, 4.5%. Germany, 2.5%. United Kingdom, 4.7%. Spain, 3.2%. Italy, 3.7%. Japan, 1.3%. China, 1.6%. G7, the US has the second highest 10-year. And they've also got the highest debt, and about 9 trillion needs to be refinanced in the next 12 to 18 months.
There we go. And of that debt, between Japan and China, they sit with 5% of that US debt, right? So
Well, they do that because here's my other fun fact. So when the market was crashing, if China really, really, really wants to play like nasty sandpit,
you load up on debt.
No. You've got about $800 or $900 billion of US debt. You sell it. So you then crash because remember you're selling debt, price down, yield up. You sell it. This takes your 10-year to 5.5. And then you go to Europe and you buy European debt. So you make American debt massively expensive. You make European debt massively cheap. And you say to America, and now showing who actually has the power. Remember the whole thing. Bond markets are irrelevant until they aren't, and when they are relevant, they drive the global economy. China could flip this whole thing on its head by giving Europe generational cheap rates and by giving America generational high rates.
This is something that reminds me very much of something that we saw on social media. And it sums up Sai's point perfectly. The United States got into a global tiff and chose the worst people to go and have a math war against.
Yeah. Remember, China is my best example. So I'll give you two. Firstly, when the pandemic hit, China just locked down their country for 3 years. No shits given. They just locked it down. But fun fact, when England essentially took Hong Kong at gunpoint in the 1800s after the Opium Wars, and they signed a 150-year contract with the UK, they came back 150 years later and said, "You guys, contract, we want the island." And I bet you the UK is like, huh?
We don't even remember
China-
the paper
What are
it
you
was
talking
written
about?
on.
China works in centuries, in millennia. The rest of the world is working in tweets, 12 seconds.
There was a Chinese official who was on a South African broadcast station last week that came out and said China's been around for 5,000 years, and for bulk of that time, America wasn't part of our trade relationships. So we don't really care about now, and we will be around for another 5,000 years. I'm paraphrasing, of course, but you get the gist of the idea.
And
they
their
see
argument
things
is
from a
America-
long-term perspective.
Massively so.
You know the good thing for us from a South African perspective? Donald has left us alone for a little bit.
Not really.
But no, I mean,
Not
his
really.
main focus
He said,
currently is China right
It
now.
is, but he said over the weekend that he's not going to be coming to South Africa for the G20
Yeah, but I
because
called
horrible things
that
are
back
happening
in
here.
February.
Absolutely, you did. You said that he was never going to even show up here. So he still believes that genocide and land confiscations and things are happening here. Interestingly enough, there was, I think, the president of Agrisa, one of our agricultural organizations. I forget the gentleman's name. I think it was Johan May. I'm not 100% sure. He was on TV and he came out and irrefutably said, "There's none of this is happening." And I remember because it was retweeted and reposted on X and all of that stuff. So the conversations from bad things are happening in South Africa to, I think the market is starting to see the South African picture and say, but Trump, you keep saying these things. Where is the empirical evidence that supports what you are saying? Now, we can get into the debate around whether or not these things are happening or not and all of that. But if you keep citing one video, and Trump did this over the weekend as well, which is a video of Julius Malema singing Kill the Boer and saying this is all happening. That video can be 10 years old and you're still citing the same video. You're not providing empirical evidence as to what's happening right now in the country and what's going on, right? Now, nobody's saying that these things may or may not be happening. That's a completely different conversation, completely irrelevant conversation. But for you to come after South Africa as an entire country on the basis of whatever other agenda you're trying to drive, because let's be clear, this has nothing to do with our foreign policy, not our foreign policy, our policy on expropriation,
On land,
our policy, those policies don't matter because the United States has an expropriation policy of their own that they conveniently forget to discuss when it comes to things like this, right? Conveniently, it doesn't exist. If it's in the... What is it? What does it say? If it is a strategic benefit or strategic
Or eminent domain or
asset
anything.
or whatever that the United
If you
States
wanna
believes
build a
has a
railway line,
strategic advantage to them, they're allowed to do that. So there's carve-out in the United States legislation that says if it is of strategic advantage to the United States, they can do whatever they want. How is that any different?
All countries have it because you want to build a railway line. You're not going to let one oak say no. You want to build a new city or something. You're not going every country has it, but you can. I mean, it's like everything, right? You can look at the same thing from two different directions.
That's it. So again, from our side, it's not a policy thing or whatever. But like you say, for him leaving us alone, I think a part of it as well, the market is also starting to be like, South Africa's not that bad. So I'd be interested to know from a South African perspective what our yields look like on our treasury. Because I'd imagine from an emerging market perspective, we would have some of the most attractive bond yields at the moment.
Sure. And so our 10-year is, it's 11.2, which is ridiculous. Our 5-year is, refreshing 9.5, and our 30 is 12.2.
So even if you don't take a long-term view on South Africa, and we're going to wrap it up on this note because I think we are out of time. Even if you don't take a long-term view on South Africa, over the next 5 years, from a South African perspective, South African government bonds are even more attractive than US government bonds.
So you get a 10-year at 11, call it 11. You lock in a currency hedge. Yeah, what's that going to cost you? I don't know, 1% or 2% maybe to lock in a currency hedge.
Call it 10.5%, call it even 10%.
10%.
10%, you've reduced your currency exposure, you're in for 10 years. Happy days. You're the happiest person ever. But unfortunately, we have run out of time. Thanks so much to Sean for joining us in studio. Shout out to our TikTok community. We have never forgotten about you guys. You guys are absolutely awesome. Thanks for joining us on the live. We're going to leave Market Matters on that note. We're going to get into our deep dive, and we're going to dive into what market competition looks like. At what point does market competition become too competitive, and at what point does it benefit the consumer? We're going to look at a couple of examples. We've got some really great examples around the car sector, around energy drinks, around all sorts of different areas. And then in our investor insights, we're going to take a look at how to negotiate a raise. So stick around for those conversations. They're going to be dropping later in the week. But for now, that's been Market Matters.